Everybody for joining us. I am Connor O'Brien, CEO of OShares, and with me, Kevin, who's chairman of OShares. So lots been going on in the markets. What do you think of the sell-off? What do you think of where we are now?
I think it's the concern, the feed versus greed, versus greed on what the economy looks like in 18 months, and it's very, very hard to know with certainty. But this is not traditionally the way you go into a recession. We're in full employment right now. Small businesses are doing very, very well. Wages have inflated, and just looking at food services, for example, a good index. The minimum wage in California is $15. You can't hire anybody for less than 21 to 25. So we're not really in a recession here. We're trying to anticipate one and having a very hard time doing it. And that's why you've got some volatility back. But the economy is very strong right now.
I mean, it's pretty unusual characteristics or circumstances that have created the inflation, caused the Fed to move up rates. The U.S. 10 years now at 3%. I remember quite a while ago. I mean, you're not the only bond forecaster in the world, but you got out of bonds so long ago, and you said, I'm not going back into bonds. I'm not even going to look at them until the 10 years over 3%. So you were right. And today's call is not all about bonds, but what do you think now? The 10 years over 3%, you going into bonds?
No, not yet. Obviously with inflation north of 6%, you can debate why we have this inflation, whether it's supply shock or whether it's the fact that we sprinkled $4.5 trillion of free cash in the economy over basically a 36-month period. You're going to get some inflation, but sitting in 10-year duration at 3% makes absolutely no sense to me at all.
And so we've had a sell-off. It kind of touched bear market territory almost, depending which index you look at, down 20%-ish. Coming off the bottom now for a number of indexes and a number of sectors. What are you doing with cash? Are you sitting on it? Are you putting it to work?
No, I'm putting it to work because, what I've learned, having gone through these cycles multiple times, and each one's different, obviously, it's impossible to time the market. And so I distribute about 6% a year out of my trust. So I'm always looking to make north of that, or at least that. Not going to do that with fixed income right now. So I'm looking for really high quality companies that either have one of two things: great balance sheets are generating a lot of cash and distributing it through the form of dividends or special dividends to me as part of my distribution. So that's very important. But also I want growth. And what's so remarkable about this market correction on certain equities, growth has not stopped. There are some great companies out there that had their PEs compressed, the price earnings ratios, but their growth rates haven't stopped. And so it's time to go tiptoeing through the tulips and put money back to work, not knowing with certainty what happens next. But, if you looked at 2000 or 2020 and you looked at 2021, you had the majority of your returns in less than 25 days. You just don't know which days. And that's always been the case in volatility. And so to try and time the market is a fool's errand, fool's game. You can't do it. So you have to deploy whatever percentage you want in equity and find the best ones to own, and then just wait. You don't know what's going to happen. But over the next 18 months, I see a lot more volatility. But again, it'll be the same thing. The returns will come in a handful of days.
Yeah, so you got to be positioned for the upside before it happens, because obviously after it happens, it's too late. You kick yourself and say, I should have, would have, could have. Let's talk about heavily levered companies for just a second. This is, again, not in our set agenda, but you made a comment there about owning high quality companies. Interest rates are going up. Leverage is tougher to handle when you get high interest rates. A lot of companies borrow short term, so they're living at the LIBOR end of the curve. What's that going to do for the more levered companies?
Well, the market's already spoken. Levered companies, particularly ones that have no earnings, have been crushed down 60, 70, 80, 90%. The market's not willing to pay for forward dreams at all. So that puts you in a place where you really want to find companies that have less leverage, stronger balance sheets, but above all have earnings and are generating cash and redistributing that back to shareholders. That's a very good place to be, so to speak, hide out in the weeds for the next 18 months. That's the kind of thing you want. Either you're taking your risk on the side of quality or you're taking your risk on the side of growth. Growth is also good. But having a speculative holding that doesn't make any money, that has a lot of debt, the market has already made its decision. It's taken that up behind the barn, and you know what happened to it.
Yeah, obviously tougher to get through an economy. If it's a slowing economy and your business isn't great and you got a lot of leverage, you've got a series of problems.